Good afternoon. Welcome back to the channel. Today is Tuesday, January the 14th. What an incredible volatile session. As you can see here on the SPY, we're looking at the 1 minute time frame for today's session. We had a nice little gap up with our PPI data coming in cooler than expected, but it was not meant to last as the market just grinded down throughout the morning session. And then during the afternoon part, around noon, we got a nice little move upward. It looked like we were going to get into this nice little consolidation bull flag situation, and we just tumbled back down around the 2 o'clock mark, only to gain a little bit back during the 3 o'clock session. But nonetheless, the S&Ps closed relatively flat, just up about 0.1%. The IWM led the way, closing up a little over 1%. The Dow closing up about 0.5 percentage point. The QQQ down slightly, just 0.1%. But a very volatile day for the stock market on Wall Street, which like I said, we've seen big swings to the upside and downside. We have CPI coming in tomorrow at 8:30 a.m. And we also have quarterly earnings from some of the biggest banks in the world. We're talking about JP Morgan, Wells Fargo, Citigroup, and Goldman. Lots of big hitters coming in tomorrow morning for earnings. But like I said, the December producer price index, the PPI, came in below the consensus estimates, although it was still higher than the November reading, as inflation continues to slightly accelerate, just at a slower pace. We also got some news from Bloomberg stating that members of Trump's economic team is considering a gradual approach to increasing tariffs, potentially by 2% to 5% per month. So I think the market is kind of trying to get a good grasp of what the incoming administration is going to look like, not to mention as what that would mean towards inflation. But we're still kind of in the same situation that we've been in since the FOMC meeting, as we can see here on the daily time frame, which is your middle chart here. We've been under pressure since that last FOMC meeting back on December 18th, which showed that there's a less likelihood of a likelihood of fewer rate cuts because of a strong economy and because of a slight uptick in inflation. And since then, markets have really been struggling to hold gains, and every bounce that we've seemed to get has been a little bit more of a selling opportunity. Quite the reversal than what we've had in the past few weeks, where it seemed like every dip was a buyable dip. Now it's just quite the opposite. But as we can see here, on the hourly time frame, I want to draw your attention here to the right-hand side of my charts. This is the SPY hourly. We can see that there is some potential here where we have an inverse head and shoulders. It's not confirmed yet. We still need to break above this 586 mark on the SPY, and one key ingredient that I'm looking at is this hourly squeeze. So this could set the stage up for a nice push up to the hourly 200, which sits at about 595. So that's what I'm looking at for the time being. Of course, we always want to consider any kind of downside moves as well. So if we do get a negative reaction to the CPI print and this inverse head and shoulder fails, we could get a nasty move to the downside, and that could be a break of this daily trend line down here, and we could see a retest of this support that was established back in November as well, to about this 568.5 zone. Below 568.5, you see this red line right here? This is the daily 200 simple moving average. Right now, we're sitting at a neutral situation here on the daily SPY. The hourly is in a strong bear. Weekly is in a neutral bull. So What that continues to tell me is that the market is still under bearish pressure on the short-term time frames while trying to maintain the overall bullish structure of the longer time frames, such as the weekly. The weekly, we can see that we're still holding on to this weekly 21 EMA, and really that's what it's all about at this moment, is that weekly 21 EMA. Can these long-term bulls hang on? And if not, if we continue to dip, what is that dip going to look like? And for me, if markets do continue to dip, the daily 200 does seem reasonable, and that would also align with a retest of the weekly 50 simple moving average on the SPY. Now, if we look at the QQQ, the battleground continues to be 500. That is my line in the sand as it remains going forward. 500, that is your weekly 21 EMA. If we start to lose that, then then we could definitely come down to the daily 200, which last time we touched the daily 200 was back in August, and that's when we aggressively had this nice little bounce and made another higher low, and we continue to march forward. But as you can see here on the daily time frame, we are still in a low compression squeeze with an hourly mid-level compression as well in that strong bear environment. So still going to keep my eye on these hourly time frames as we progress forward, and we'll see what happens next. So what this translates to, and I've said it before in the past few videos, is that when we get into this environment, it's best to play defense. And, if you're swing trading, don't swing as heavy. Keep, if you do open up any new positions, keep it light until things settle back in. We are in a high VIX situation at this time being. As you can see here, with the VIX is hanging out at the 18 mark. You can see, you can see here the volatility today was just absolutely insane. The volatility of volatility was even crazier. So yeah, we just have to be patient and wait for things to start to turn around on some of these smaller time frames, especially if you are more of a bull than you are a bear. Now, if you are market bears, it's still your market to lose, and we want to choose our battles. Like, for example, this morning, that nice little gap up and fade throughout the day was phenomenal, and just the way to play it. And until you're proven wrong otherwise, it's still just the bears market. So we'll let things continue to shape up. Like I said, we got CPI tomorrow morning. The expectation is 2.9%. That is the median forecast. Core CPI is expected to come in at 3.3%, a slight uptick. As you can see, 2.9 from 2.7. 3.3 should be coming in line with the prior reading. So we definitely want to keep an eye on CPI in the morning, as well as those bank earnings. And then after this reading on the inflation data, we get core retail sales on Thursday, unemployment claims, and then end things out with building permits and housing starts. So we're not out of the woods yet after tomorrow. Still got a few data points, but definitely this is our key focus going into tomorrow. All right, guys, that's going to be it for today's update. We'll have more tomorrow once we get this inflation reading out of the way. I'll have more to discuss for tomorrow's video with the midweek update. All right, guys, take care. Have a good one. Be good.